Hello, everyone. We need to talk about what just happened in the silver market, and I'm recording this urgently because the next 72 hours are going to be absolutely critical. Silver is trading at 84.20 right now as I speak, and here's what almost nobody is discussing. China has been completely absent from the physical market for the last 6 trading days due to Lunar New Year closures, and they reopen Tuesday morning. While Western paper traders have been pushing silver around, the largest physical buyer in the world hasn't been able to respond. We're looking at a potential explosion that could send shockwaves through every metals market on the planet. By the end of this video, you'll understand exactly why institutional players are positioning right now before Tuesday's open and why the next 96 hours could define the entire first quarter. Watch this till the very end because what I'm about to show you about vault movements and Shanghai premium divergence is critical information. Let me paint the picture of what's happening right now. Silver is sitting at $84.20 on COMEX as of 3:17 p.m. Eastern Time today. That's up from $76.80 just 5 days ago, marking a 9.6% rally while China's been out of the market. But here's where it gets interesting. The last time China was active, on February 9th, before their markets closed for holiday, the Shanghai premium was sitting at $4.20 per ounce above COMEX spot. That's already elevated, but not extreme. Fast forward to today, and we're seeing forward contracts for delivery after March 3rd trading at premiums of $11.80 in gray market channels. That's a 181% increase in premium, while Chinese institutional buyers have been unable to participate in price discovery. Think about what that means. The paper price rallied nearly 10% without the world's largest physical buyer even in the game. Dealers in Hong Kong are reporting that pre-orders for delivery after Shanghai reopens have absolutely exploded. One major dealer told us they've taken orders for 847,000 ounces scheduled for delivery the week of March 3rd. That's more than triple their normal weekly volume. The physical market is screaming one thing, while COMEX shows something completely different. Now let's dive deep into the data because the numbers are revealing something extraordinary. COMEX registered inventory, the silver that's actually available for delivery, currently sits at 94.7 million ounces, as of yesterday's vault report. That's down 4.2 million ounces in just the last 8 trading days. But here's the critical number. Open interest for March contracts stands at 71,200 contracts right now. Each contract represents 5,000 ounces, which means there are paper claims on 356 million ounces of silver. Do the math with me. That's a coverage ratio of 3.76 to 1. For every physical ounce sitting in registered vaults, there are 3.76 paper claims against it, and this is before China comes back to the market. Let me show you what's happening at the vault level because this is where the real story emerges. Yesterday alone, February 21st, we saw movements totaling 2.34 million ounces across COMEX vaults. Of that, 1.68 million ounces were withdrawals from registered into eligible category, meaning it's no longer available for delivery against futures contracts. JP Morgan's vault, which holds the largest registered inventory at 31.2 million ounces, saw outflows of 890,000 ounces just yesterday. Meanwhile, Delaware Depository reported registered inventory dropping by 540,000 ounces. This is happening while silver rallies and while China isn't even buying yet. What happens when Shanghai reopens and institutional buyers start hitting bids? The lease rates are telling us something critical is building. 1-month silver lease rates just hit 4.8%, up from 1.9% 2 weeks ago. That's a 153% spike in borrowing costs. When you see lease rates exploding like this, it means there's stress in the physical lending market. Banks and institutions that normally lend silver for a small fee are either pulling back their lending or demanding much higher compensation for the risk. The 3-month lease rate is sitting at 5.6% right now, which is the highest we've seen since the banking crisis last March when we hit 6.1%. CVOL, the Silver Volatility Index, is currently at 87.4, elevated but not extreme. For context, during the 2023 banking panic, it hit 142. But watch this number closely Monday and Tuesday. Here's where the institutional positioning gets really interesting, and this is where you need to pay attention because the timing is absolutely suspicious. According to the latest CFTC Commitment of Traders report released last Friday, covering data through Tuesday, February 18th, commercial traders, the big banks and institutions, added 8,400 net short contracts in that single week. They increased their short position from 42,600 contracts to 51,000 contracts, while silver was trading between $78 and $82. Now ask yourself, why would major banks be adding massive short exposure right before the Chinese market reopens after an 8-day closure? Let me connect some dots for you. On February 7th, 2 days before China closed for Lunar New Year, there was an unusual concentration of sell orders that hit COMEX between 2 a.m. and 3:30 a.m. Eastern Time. During that 90-minute window, 3,780 contracts were sold, pushing silver down from $79.40 to $76.60, a $2.80 drop in the middle of the night. The timing is critical because this happened during Asian trading hours, right before China's last trading day before their closure. Then, once China went dark, we saw that aggressive short buildup I just mentioned. Someone wanted to establish a massive short position while the world's largest physical buyer was unable to respond. But here's what they might not have anticipated. Despite that short positioning, despite the coordinated overnight pressure, silver still rallied 9.6% while China was out. And now, those same institutions are sitting on 51,000 short contracts with silver at $84.20, which means they're already showing unrealized losses. If silver breaks above $90 before they can cover, we're talking about a squeeze situation. Remember 2020 when JP Morgan paid $920 million in fines for precious metals spoofing? The same playbook is visible right now. Build shorts while a major buyer is absent, try to control the rally, then hope to profit on the way down. Except this time, the physical market isn't cooperating. The evidence is showing up in dealer networks across Asia. I've been tracking premiums in Singapore, Hong Kong, and Taiwan throughout China's closure, and what we're seeing is unprecedented. Singapore dealers are quoting $8.40 per ounce over spot for immediate delivery of 1,000-ounce bars. That premium was $3.10 on February 9th. Hong Kong premiums for kilo bars jumped from $0.68 per ounce to $6.90 per ounce. These are wholesale institutional premiums, not retail. When you see wholesale premiums exploding like this during a period when the largest buyer is absent, it tells you something critical. There's a severe shortage of physical silver in Asia, and dealers are pricing in what they expect to happen when China returns. Now here's the twist that shocked me when I discovered it yesterday, and this is where the narrative completely flips. While everyone is looking at the COMEX short buildup and thinking this is a bearish setup, look at what's actually happening in the physical world. The Shanghai Gold Exchange, which also trades silver, had forward silver contracts for March delivery trading at $96.80 per ounce before they closed on February 9th. COMEX spot that day was $79.20. That's a $7.60 premium, or 22.2% above Western prices. Now, in gray market forward transactions for delivery after March 3rd, we're seeing prices of $96 with COMEX at $84.20. The premium actually compressed slightly to $11.80, but here's what's critical. It compressed while COMEX rallied $7.40. The physical market in China is expecting even higher prices, which is why the premium narrowed during the rally. They're pricing in $96 to $98 silver the moment their markets reopen. And there's one more piece of this puzzle that almost nobody is discussing. A Chinese state-owned commodities firm, China Minmetals, filed a disclosure on February 6th showing they established long positions in London for 4.2 million ounces of silver scheduled for delivery in March. That's $353 million worth of silver at current prices, and it was positioned 3 days before China's market closure. This isn't a hedge. This is a directional bet. A state-owned enterprise betting $353 million that silver prices are going higher, timed precisely before their domestic market closes and just before we see this massive short buildup on COMEX. Do you see the setup? Western banks building shorts while China is dark. Chinese state firms building longs before they go dark. One side of this trade is about to be very, very wrong. Let me give you the technical roadmap because we need to understand exactly what price levels matter in the next 72 hours. Right now, as I'm recording this at 3:47 p.m. Eastern on Friday, February 21st, silver is at $84.20. The immediate resistance level is $87.60, which represents the 150-hour exponential moving average. If we get a body close above $87.60 on the daily chart, that triggers algorithmic buy programs, and we immediately test $92 to $94. Above $94, there's very little resistance until we reach the February 2nd high of $118.40. That would represent a 40.6% rally from current levels. Here's the bullish scenario in detail. If silver holds above $82 support through Monday's trading and then Shanghai opens Tuesday morning with buying pressure as expected, we could see a gap up opening above $88. Chinese buyers coming back after 8 days, seeing elevated premiums, and rushing to secure physical could trigger a short covering rally on COMEX. Those 51,000 commercial short contracts I mentioned, if just 30% of them try to cover simultaneously, that's 15,300 contracts, or 76.5 million ounces of buying pressure hitting a market with only 94.7 million ounces of registered inventory. The math doesn't work. We'd see a vertical move to $95 to $100 within 24 to 48 hours of Shanghai's reopening. But I have to give you the bearish scenario too, because risk management matters. If we see selling pressure Monday that breaks the $82 support level, the next technical support doesn't come in until $76.80, which is where this rally started. A breakdown below $76 would target the 200-day moving average at $71.40. In this scenario, those commercial shorts would be proven right, at least in the short term, and we'd likely see a flush down to test that $71 level before finding buyers. The key indicator for this bearish path would be if Shanghai reopens Tuesday and we don't see aggressive physical buying. If Chinese buyers hold back, waiting for lower prices, that would confirm the bearish thesis. The deciding factors are going to reveal themselves in a very specific timeline. Monday, February 24th, watch the opening price. If we gap up above $86 on Sunday night futures, that's Western traders positioning before Shanghai opens. Then Tuesday, March 3rd at 9 a.m. Shanghai time, which is 8 p.m. Monday Eastern time for us, we'll see the first print from Shanghai Gold Exchange silver contracts. The opening premium versus COMEX will tell us everything. If Shanghai opens with a premium above $15 per ounce, that's your confirmation that physical demand is extreme. If the premium is below $8, it means Chinese buyers aren't as aggressive as feared. Wednesday, March 5th is first notice day for March COMEX silver contracts. This is when contract holders must declare if they're standing for physical delivery or rolling to later months. Currently, there are 71,200 open contracts for March. Historical average for standing for delivery is about 8% to 12% of open interest. But if we see more than 15% stand for delivery, that's 10,680 contracts or 53.4 million ounces, demanding physical settlement against registered inventory of 94.7 million ounces. The delivery stress would be immediate and obvious. Here's exactly what you need to monitor over the next 96 hours. First, Shanghai Premium when they reopen Tuesday. Anything above $15 per ounce is extremely bullish. Second, COMEX registered inventory. If we see withdrawals exceeding 2 million ounces on Monday or Tuesday, that's confirming physical tightness. Third, open interest for March contracts. If it stays above 65,000 contracts heading into first notice day, delivery stress is likely. Fourth, the commitment of traders report next Friday will show us if commercials added even more shorts this week or if they started covering. And fifth, lease rates. If 1 month lease rates break above 6%, we're in crisis territory. There are also specific macro events that could accelerate this situation. Monday morning, we get the ISM Manufacturing Index at 10 a.m. Eastern. If that number comes in below 48.5, showing contraction, it could trigger safe haven buying into silver. Tuesday afternoon, the Fed releases minutes from their last meeting at 2 p.m. Eastern. Any hints of pause in their hawkish stance could ignite precious metals. And Thursday, March 6th, we get jobless claims at 8:30 a.m. Eastern. A number above 225,000 would signal labor market weakening and support metals prices. The geopolitical backdrop matters too. Tensions between the U.S. and China over trade policy have been escalating. If there's any announcement of new tariffs or trade restrictions between now and Tuesday, Chinese buyers might accelerate their silver purchases as a hedge against currency volatility. Silver serves as both an industrial metal and a monetary hedge, which makes it particularly attractive to Chinese institutions during periods of geopolitical uncertainty. One more critical detail about vault movements that we need to discuss. In the last 30 days, eligible silver inventory, the metal stored in COMEX vaults but not available for delivery, has increased by 8.7 million ounces to 238.4 million ounces total. Meanwhile, registered inventory dropped by 11.2 million ounces. This means metal is being moved from deliverable to non-deliverable status. Owners are saying, I want my silver in the vault, but I don't want it available for delivery against futures contracts. This is classic pre-shortage behavior. Holders are keeping metal close, but restricting supply. When we see this pattern accelerate, it precedes price spikes. We saw the exact same pattern in March 2023 before silver ran from $72 to $95 in 18 days. So here's what we know right now as of this moment. Silver is at 84.20 after rallying 9.6% while China was closed for 8 days. The Shanghai premium exploded from 4.20 to forward prices of $11.80, a 181% increase. COMEX registered inventory is bleeding, down 11.2 million ounces in 30 days. Commercial shorts added 8,400 contracts at suspicious timing. Chinese state firms positioned $353 million in long exposure before going dark. Lease rates spiked 153% to 4.8%. And all of this happened before the world's largest physical silver buyer even returned to the market. The next 72 hours are absolutely critical. Tuesday morning, Shanghai reopens. Wednesday is first notice day. The market hasn't faced Tuesday yet, and when it does, we're either going to see confirmation of extreme physical demand that sends silver vertical, or we're going to see Chinese buyers hold back, validating the bearish short positioning. One side of this trade is positioned for massive losses. Watch the 87.60 resistance and the $82 support. Watch Shanghai's opening premium. Watch registered inventory. This is not the time to be complacent. If this analysis added value and helped you understand what's actually happening beneath the surface of these markets, smash that like button right now. Drop a comment below with your price prediction for silver by next Friday, March 7th. Are we breaking $100 or testing $76? I want to hear from you. Subscribe if you haven't already because I'll be tracking this situation minute by minute and will update you the moment Shanghai opens Tuesday. Hit that notification bell so you don't miss the urgent updates. This is financial warfare education, not investment advice. I'm analyzing market structure and positioning, but you need to do your own research and make your own decisions. Never invest more than you can afford to lose, and understand that precious metals markets are extremely volatile and can move against you rapidly. The scenarios I've outlined are possibilities based on current data, not certainties. Stay vigilant. I'll see you in the next one. Please like and subscribe.